There are people who earn $50,000 a year and become millionaires. And there are people who earn $200,000 a year and stay broke. The difference isn't the income, it's not luck, it's not connections or inheritance, or being in the right place at the right time. The difference is how they think about money. And I'm not talking about positive thinking or manifestation or any of that nonsense. I'm talking about specific, measurable differences in decision-making frameworks that consistently produce different outcomes. The wealthy think about money in fundamentally different ways than poor people do. And these differences compound over decades into completely different financial lives. If you can identify these thought patterns in yourself and change them, you can change your financial trajectory regardless of where you're starting from. Warren Buffett started buying stocks at age 11 with money he saved from delivering newspapers. And selling gum, he wasn't born rich. His early capital came from working. But even as a child, he was thinking differently about money than his peers. While other kids were spending their earnings on candy and toys, Buffett was buying assets. While other kids were thinking about what they could buy next week, Buffett was thinking about what those assets would be worth in 10 years. That difference in thinking, that different framework for evaluating what to do with money, that's what turned a paper route into billions of dollars. Not intelligence. Not hard work. Different thinking. Let me show you the 7 specific differences between how rich people think about money and how poor people think about money. And I want to be clear about something before we start. When I say poor people, I'm not talking about people with low income. I'm talking about people with a poverty mindset. You can have a poverty mindset while earning 6 figures. You can have a wealth mindset while earning minimum wage. The mindset is what determines whether you build wealth or stay stuck. Income is just one variable. Mindset is the operating system that determines what you do with that income. Difference. Number 1. Rich people think in terms of net worth. Poor people think in terms of income. Ask a poor person how they're doing financially and they'll tell you their salary. I make $70,000 a year. Ask a rich person and they'll tell you their net worth. I'm worth $2 million. This seems like a small semantic difference, but it reveals everything about how they think. Poor people focus on the rate at which money comes in. Rich people focus on the total amount of wealth they've accumulated. And this changes every financial decision. When you think in terms of income, you're focused on earning more. You want a higher salary, a better paying job, a promotion, a raise, and those things are fine. But they don't build wealth by themselves. Because if you earn more but spend more, you're no wealthier. You're just on a faster treadmill. When you think in terms of net worth, you're focused on the gap between what you earn and what you spend and what you do with that gap. You're thinking about savings rate, investment returns, asset accumulation. You're measuring success not by your paycheck, but by your balance sheet. Warren Buffett has said that the best investment most people can make is in themselves, increasing their earning power. But he immediately follows that by saying you need to convert that earning power into wealth. The earning is just step 1. Building net worth is step 2. And most people never make it to step 2 because they're stuck thinking about step 1. They get the raise and immediately upgrade their lifestyle. New car, bigger apartment, more expensive habits, and their net worth barely changes even though their income went up 20%. The rich person gets the same raise and their lifestyle doesn't change at all. That entire raise goes into investments, into building net worth. Same income increase, completely different outcome because of completely different thinking. Difference. Number 2, rich people buy assets, poor people buy liabilities and think they're assets. This is the fundamental difference that Robert Kiyosaki talks about in Rich Dad, Poor Dad, and it's absolutely correct. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. It's that simple, but poor people constantly confuse the two. They buy a new car and they think they bought an asset. They didn't, they bought a liability. That car is taking money out of their pocket every month. Car payment, insurance, gas, maintenance, depreciation. It's a money drain, not a money generator. Rich people understand this distinction viscerally. They buy rental properties that generate monthly income. They buy dividend stocks that pay them quarterly. They buy businesses or parts of businesses that produce cash flow. These are assets. These put money in their pocket. Now, I'm not saying. You can never buy things that are liabilities. Everyone needs a car. Everyone needs housing. But rich people minimize spending on liabilities and maximize investment in assets. Poor people do the opposite. They spend heavily on liabilities, cars, furniture, clothes, entertainment, and barely invest in assets at all. And they might have a 401k that they contribute 3% to, but that's it. Everything else is consumption. And then they wonder why they're not building wealth. Warren Buffett drives a modest car, lives in a modest house, and doesn't spend money on most of the things that people think rich people should buy. Why? Because he understands that every dollar spent on liabilities is a dollar that can't be used to buy assets. Every dollar that goes toward a luxury car payment is a dollar that can't be invested in stocks that will compound for decades. When you really internalize this, when you viscerally feel the opportunity cost of buying liabilities instead of assets, your spending behavior changes completely. You stop wanting the expensive car because you can see what you're giving up to have it. That's how rich people think. Difference number 3, rich people think long-term, poor people think short-term. This might be the most important difference on the list. Poor people make decisions based on immediate gratification. They want what they want now. They can't delay gratification. They can't make short-term sacrifices for long-term gains. Rich people are the opposite. They're willing to live below their means for years or decades because they're focused on where they'll be in 20 or 30 years, not where they are today. They plant seeds knowing they won't see fruit for years, and they're okay with that because the long-term payoff is worth the short-term sacrifice. Let me give you a concrete example. A poor person gets a $1,000 bonus at work. They immediately think about what they can buy with it. New TV, weekend trip, upgrade their phone, something that gives them pleasure now. A rich person gets the same $1,000 and immediately thinks about what it could become. Invested at 10% annual returns, that $1,000 becomes $2,500 in 10 years, $6,700 in 20 years, $17,000 in 30 years. They're not thinking about the TV they could buy today. They're thinking about the $17,000 they could have in retirement. Same $1,000. Completely different framework for thinking about what to do with it. Warren Buffett has talked about this as the difference between consuming your seed corn versus planting it. You can eat your seeds and satisfy your hunger today, or you can plant them and harvest many times more in the future. Poor people eat the seeds, rich people plant them. And it's not because rich people don't want things. It's because they want the future more than they want the present. They have a different time preference. They can delay gratification because they understand compounding. They understand that small sacrifices today become large rewards tomorrow. Difference number 4. Rich people invest in appreciating assets. Poor people spend on depreciating liabilities. This is related to difference number 2, but it's worth breaking out separately because of the appreciation versus depreciation component. Even when poor people do buy what they think are assets, they often buy things that go down in value. A new car loses 20 to 30% of its value the moment you drive it off the lot. Over 5 years, it might lose 60 to 70% of its value. You paid $40,000 for something that's now worth $12,000. That's not wealth building. That's wealth destruction. Rich people buy things that go up in value over time. Real estate in good locations, stocks in good companies, their own businesses. These things appreciate. In 10 years, the rental property they bought is worth more than they paid. The stocks have grown. The business has increased in value. Their wealth is compounding upward. The poor person's car is worth almost nothing. The furniture they bought is worthless. The clothes are worn out. After 10 years, the rich person is significantly wealthier. The poor person has nothing to show for a decade of spending. Warren Buffett's wealth is entirely in appreciating assets. Stocks that have compounded for decades. Businesses that throw off increasing cash flow every year. He owns almost nothing. That depreciates. No yacht that requires maintenance. No private jet that loses value. No car collection. Just appreciating assets that make him richer every year he holds them. And this isn't because he's cheap or doesn't like nice things. It's because he understands that appreciating assets are how you build wealth. Everything else is just consumption that makes you poorer. Difference number 5. Rich people use leverage strategically. Poor people either avoid debt entirely or use it destructively. This is nuanced because you hear different advice about debt depending on who you listen to. Dave Ramsey says all debt is bad. Robert Kiyosaki says good debt is how you get rich. Who's right? They both are for different people. Poor people fall into 2 categories. Either they're terrified of debt and avoid it entirely, which means they miss opportunities to use leverage to build wealth, or they use debt destructively, financing consumption on credit cards, buying cars they can't afford, living beyond their means. Both approaches keep them poor. Rich people use debt strategically. They borrow money at low interest rates to buy assets that appreciate or generate income at rates higher than the cost of the debt. Borrow at 4% to buy real estate that appreciates at 6% and generates cash flow. That's smart use of leverage. Borrow to buy stocks on margin when you're getting a deal? That can be smart if you're sophisticated. Borrow to invest. In your business that's generating returns of 20 or 30%? Absolutely smart? The key is that the debt is used to acquire assets, not to fund consumption. And the return on the asset exceeds the cost of the debt. Warren Buffett uses massive amounts of leverage, but not in the way most people think. Berkshire Hathaway owns insurance companies that collect premiums up front and pay claims later. That's float. It's other people's money that Buffett gets to invest. It's a form of leverage, and he's used that leverage brilliantly to compound returns for decades. But he's never used margin debt to buy stocks. He's never borrowed recklessly to fund consumption. He uses leverage strategically to amplify returns on investments, not to buy things he can't afford. That's the difference. Difference number 6. Rich people focus on opportunities, poor people focus on obstacles. This is psychological, but it has enormous practical implications. When presented with an opportunity, a poor person's first thought is all the reasons it won't work. All the obstacles, all the risks, all the ways it could fail. They're looking for reasons to say no. A rich person's first thought is how to make it work. They see the same obstacles, but they view them as problems to solve, not reasons to quit. They're looking for reasons to say yes. This plays out in every area of wealth building. Investment opportunity comes up. Poor person thinks, I don't have enough money. I don't know enough about it. What if it fails? What if I lose everything? Rich person thinks, how can I get the capital? Who do I know that understands this? How can I structure it to limit downside? What's the potential upside if it works? Same opportunity. Completely different response because of completely different thinking patterns. Warren Buffett has said that in his entire career, he's probably only had a dozen really great investment ideas. But he went big on those ideas when he found them. He didn't let obstacles stop him. When he wanted to buy See's candies and the price was higher than his initial offer, he didn't walk away. He found a way to make it work because he recognized it was a great business. When he wanted to buy insurance companies but didn't have enough capital, he found creative structures to make it happen. He focused on the opportunity, not the obstacles. Poor people would have seen the high price or the lack of capital as reasons to give up. Rich people see them as problems to solve. Difference number 7. Rich people build systems. Poor people trade time for money. This is the ultimate difference. Poor people think in terms of jobs and salaries and hourly wages. They trade their time for money. If they work more hours, they make more money. If they stop working, the money stops. They're human capital. They're the asset that generates income. Rich people build systems. They create businesses, investment portfolios, rental properties, things that generate income without requiring their time. They're not the asset. They own the assets. And those assets work for them while they sleep. This is why wealthy people seem to have so much free time. They're not working 80 hours a week. They might work a lot on building their systems initially, but once the systems are built, the systems run themselves. The rental properties generate income every month whether the owner is working or on vacation. The dividend stocks pay quarterly whether the owner is at a desk or on a beach. The business has employees and processes that function without the owner's constant involvement. Poor people can never stop working because they are the system. If they stop, everything stops. Warren Buffett reads for hours every day. He's not in meetings constantly. He's not working 16-hour days. He built systems decades ago that generate enormous wealth without requiring his constant intervention. Berkshire Hathaway owns businesses that are run by managers. He owns stocks that compound without him needing to do anything. He built systems, and now the systems work for him. That's the ultimate goal. Build systems that generate wealth independent of your time. Then you're truly free. You have time freedom and financial freedom. Poor people never build systems. They just trade time for money forever. And that's why they stay poor, putting it all together. These 7 differences aren't just philosophical. They're practical frameworks that determine what you do with every dollar, every opportunity, every decision. When you think in terms of net worth instead of income, you make different spending decisions. When you focus on buying assets instead of liabilities, your purchases change. When you think long-term instead of short-term, you can delay gratification. When you prioritize appreciating assets over depreciating purchases, you build wealth instead of destroying it. When you use leverage strategically instead of destructively, you amplify returns instead of amplifying risk. When you focus on opportunities instead of obstacles, you say yes to things that could change your life. And when you build systems, instead of just trading time for money, you create freedom. The beautiful thing about mindset shifts is that they're available to anyone. You don't need money to start thinking like a rich person. You can start today, right now, regardless of your income or your current financial situation. You can start measuring your net worth instead of just your income. You can start looking at every purchase and asking, is this an asset or a liability? You can start thinking about what your money could become in 10 or 20 years instead of what you could buy with it today. You can start seeking appreciating assets instead of depreciating purchases. You can start viewing debt as a potential tool instead of something to avoid or abuse. You can start looking for opportunities instead of obstacles. And you can start thinking about systems you could build instead of just time you could trade. Warren Buffett's wealth didn't come from being the smartest person in the room. It came from thinking differently about money than everyone else in the room, from having frameworks for decision-making that consistently led to wealth-building choices instead of wealth-destroying choices. And those frameworks, those ways of thinking, they're learnable, they're teachable. They're available to you if you're willing to examine your own thinking and change it, because that's what this really comes down to. Are you willing to think differently? Are you willing to question the assumptions about money that you inherited from your parents, from your community, from society? Are you willing to adopt ways of thinking that might feel uncomfortable or unnatural at first, but that lead to better outcomes? Most people aren't willing. They want to get rich, but they don't want to think differently. They want the results that come from a wealth mindset while keeping a poverty mindset. And that doesn't work. You can't think like a poor person and expect rich person results. The thinking determines the behavior. The behavior determines the outcomes. If you want different outcomes, you have to change the thinking first. Start with these 7 differences. Internalize them. Practice them. Make them your default way of thinking about money. And over time, over years and decades, you'll find that your financial life looks completely different. Not because you earned more necessarily, but because you thought differently about what to do with what you earned. And that difference in thinking compounds into a completely different life.